Hey, everybody. Welcome to Market Mavericks. It is Thursday, 3 p.m. And of course, the Mavericks are back. And of course, we have a special guest, Andy Schechtman here, founder and CEO of Miles Franklin Precious Metals. Andy, thank you for joining the Mavericks.
It's awesome. Good to be here, guys. Thanks for having me. I appreciate it.
Wonderful. And of course, we have Scott Melker and Mike McGlone, the original Mavericks, right here. But I love bringing in new viewpoints and new analysis because I think it's so valuable to the viewers to kind of understand that there is many things out there, many experts out there, and Andy certainly is that. All right, so number one, we've got to look at the S&P today. This is the big event here, folks. Number one, let's take a look. This is my chart here of the S&P, and this is the weekly chart, or the daily chart. But what we see today is this gap up on the back of NVIDIA earnings, and then just this massive sell-off. And again, this is one of these things where, to me, it was euphoria, right? Peak euphoria. Jensen Huang yesterday comes out and he just talks about how, there's unlimited supply of demand, so much demand for these chips, off the charts, I believe it was his quote. And the markets initially opened sharply higher, and then it just all fell apart. So, Mike, tell us, why did it fall apart, buddy?
Well, markets peak on euphoria. We're seeing classic de-risking. We just look at Bitcoin. It was up 33% on the year. Right now, it's down 8%. And a year that gold's up 55%, I'm sure Andy's going to knock on that one a little bit, are we going to look back from the future and say, yeah, gold's up 50% and speed everything, it didn't really matter? And I think it's now starting to matter. We're finding out what happens when bull markets end is markets stop going up, even though earnings and all the news becomes better and better. It's usually the way bull markets peak. And I think we're doing that now.
So one of the things I think the retail investor is so used to being like, okay, there needs to be a negative headline catalyst like tariffs, right? Like we saw with Trump in April. But in this situation, it's not that there's a negative, it's just things have gotten too stretched. Is that what you're saying?
Yeah, we've all been through this before. I remember the housing market in 2006. It just went too high and stocks followed later. The stock market in 1999 and 2000, same thing. I remember watching Joseph Battipaglia pointing out how bullish he was. NASDAQ at 5,000 a day it peaked, and I didn't hear much about him later. And it dropped to like 1,800. It's just the way things are. The key thing is what's happening with the timing. It's that time of the year. It's not the time of year to add to risk. It's the time of year to de-risk, and we're hitting that very significantly. Also, we've had a major dearth of data. Data is just an opportunity for people to do things. I don't think it matters at all, the data. It's an excuse for people to either buy or sell, and now they're all selling. The key thing I'm worried about now is what we're seeing happening this year is Bitcoin breaking down, gold rallying is signaling things that are going to matter and look back from the future. And I can show you a few charts and we can flip it over. I can wait till later in that. But it's the key thing I'll point out is we have had the VIX 200-day moving average in a bull flag since April. It's breaking out higher. We still have 120-day volatility in S&P 500 at 11%. That's the lowest. On a year-end basis, it'll be the lowest since 2017 if it doesn't go up. There's just nothing good here. And then I'm really worried. The key thing I'm worried about is the stock market just follows the lead of Bitcoin. It was up a lot and to end up down in the year. That would be a crash, but we're heading that way now. And it's the time of year people are just de-risking what stops it. I don't know anything stops us now.
So quickly here, so you said nothing good out there, right? And you certainly said sell everything weeks ago. And so far, anyone who did is pretty darn happy, I would say. But Andy, looking at the chart of gold here, gold is actually green on the day. Are you seeing people still very interested in being in gold, in buying gold, hedging against market volatility here?
It's interesting because the public is really hasn't been a massive participant in the gold rally. It's been more along the lines of the central banks and whoever the heck is importing billions upon billions every month into COMEX, the sophisticated traders. Maybe it's some of the people listening to the chief investment officer of Morgan Stanley who said, sell half your bonds and put 20% into gold, or Michael Hartnett from Bank of America who said, no, make it 25%, or Jeffrey Gundlach who said, no, 25% is not overweight. Things I never, ever thought we would hear. I think the public is behind the curve. And if you look at the recent data, they're all in the stock market, highest ever, largest margin debt ever, largest option exposure ever. The public's in the market. The big money, the central banks, the commercial banks, the sovereign wealth funds, they're the ones that have been driving not only the gold accumulation, but the deliveries off of the exchanges. So I think the public is the last one to get involved, and really, other than some very large orders by people who are paying attention, I would say the public at large is not involved in this market hardly at all.
That's
Andy, can I ask you a
amazing to
question?
hear.
Do you
Right.
mind if I
Sorry,
ask you a
Scott, you go.
question? Just to that end, interestingly, I think when retail really did try to get involved was when people were lining up in Australia and it was at that local top, right? So we saw that on the news, and I think that's classic market behavior. What do you think it would take for the classic 60-40, the RIAs in the world to finally decide, hey, we need some sort of allocation to precious metals, a 60-35-5 or a 55-5-50, whatever it would be? It seems very strange to me that even with this massive move on gold, you don't hear people advising retail to put it in their portfolio.
Yeah, it's strange to me too. I mean, maybe it's just been so whitewashed out of the ecosystem that they don't think about it. I mean, one of my very best friends is manages 3 billion for Morgan Stanley here in Boca, one of the biggest in the state. And he wouldn't know a gold coin if it fell on his foot, yet their chief investment officer is saying put 20% in gold. So I don't know. I think typically, and maybe this is why there's the whole theory of Elliott wave and Kondratiev wave theory, human emotions that drive the market. I think maybe they have to see it with their own eyes. But, people who are successful, I think, move before the trend. And that seems to me to be the central banks who've been doing this for the last 8 years, and now the sovereign wealth funds, and now the commercial banks. So I don't know. Maybe it just is validation they need to see with their own eyes instead of doing what the biggest money has been quietly doing for quite some time. And you look at how gold has performed. It's really done amazingly well, and it's outperformed most assets. The fact that it hasn't been embraced, I don't know. It's a mystery to me, quite frankly. But I would think that it has to be validated by people's own eyes before you see anything substantive with the public or the local money managers or financial advisories.
I would also think that once it's fully embraced, that usually signals a top. So in the scheme of things, it's probably not even at the top yet, and it's got much more to go, right?
That's the idea. I mean, that's kind of what I'm getting at, is that, I just stopped talking about what I do with my friends unless I'm asked. By now, a lot of people know what I'm doing, but it's so misunderstood by even people who are very well read. Maybe they just read the wrong stuff. And I got another money manager, ironically from Morgan Stanley, lives across the street from me. And the only time he ever says anything to me is when gold and silver fall. You yell across the street from me, "What's going on with metals?" I want to just say, "Shut up, man." And he never talks to me about the fundamentals. It's buy bonds and retire, blissfully. I just think that it's been whitewashed so much to such an extent that the public doesn't quite get it yet. But you look at a market that, has doubled the performance of the 10-year Treasury over the last 25 years. You can take the S&P and with dividends reinvested, which nobody ever does over that same time frame, gold beats it just barely, 9.9 to 9.6. Look at it last year, up 60%, up this year, 60%. At what point do people start to legitimize it? I don't know. But ironically, if you take any asset you can think about, just about, and value it in ounces of gold, going all the way back since 1971, prices are falling in gold ounces. They're going way up in dollars. It just is continually outpacing people's expectations, but yet they don't even notice it. They don't acknowledge it. And here we are with it being one of the best performing assets of the last decade, and it's completely and totally underowned by the public. For whatever reason, I don't know.
Well, I mean, I'm more of a trader, and I love hearing that point of view because it makes me bullish on it, right? It's when everyone else is involved and screaming it from the rooftops, that's where I'm like, all right, now I need to start taking profits or shorting into that. So again, I'm in agreement. Whether we come a little bit lower or not, I think next year we easily see that 5,000 marker on gold, and then on beyond that, I think further. But I also think part of the issue with retail adopting it is that gold still has that mantra of being slow and steady wins the race, right? Versus, altcoins can be 1,000% return. You can have stocks going up ridiculous amounts. And that really hurts it until people start getting burned in those other things. And I think we're starting to see that in altcoins. I mean, some of the altcoin performance, and Scott, you could speak to this, is just horrendous right now. And then we're also seeing stocks beginning to tumble. I mean, Rigetti Computing, this supercomputer stock, up thousands of percentage points for the year, down 60% for just in the last month. So speaking of crypto, Scott, let's get into this. What on earth is going on? What's that?
Can we just skip it for today? No, I'm just kidding. There's a lot more people selling than buying. Yeah. Obviously, we've got now roughly 30% drawdown, which is still in the territory of something that we get 4 to 7 times every single bull market. But if we're being honest, that 50 MA is pretty glaring right there, that blue line. We've never seen the 50 MA roll over and have a breakdown in a bull market. And we've never in the history of Bitcoin, given its very limited statistical data set of a few times it happened, but we've never seen it break without visiting the 200, which is down there at 55, 56 and rising. So I know a lot of people will be watching that line. For me, 88 was a big line that had never been tested. I had bid that since April and didn't feel a need to change those. So those filled up pretty heavily today. My last real area of interest before that 50 down there is the kind of 74 area where we went to before. Breaking that level, all of a sudden you're out of a higher highs and higher lows environment of, bull market structure that a lot of people look at technically. So I think it's very conflicting narratives at the moment, but I think you're seeing, Mike, you always make the leading risk argument. I would almost make the argument that now with Bitcoin trading down on the year and the S&P still only 5% off the highs, that Bitcoin has been uncorrelated all year. I mean, it's trading lower than it was a year ago. It's trading lower than it was in January. Normal volatility in Bitcoin, 25% above 100, 25% below. That's what we've seen, literally going up to 126 and down to 74. It's like clockwork. So if that's a big range, there's nothing really untoward here, I think, with Bitcoin. But there's an ugly sell-off. There's no question. And never ceases to amaze me how much leverage can still be added even with the flushes, and how many people are willing to sell Bitcoin in size at every price.
So I got to piggyback on that a little. That's one of the key reasons I made that statement about a month ago, and still stick with it. Is let's put ourselves looking back at 2025. Bitcoin had this major new high in reversal. Is the stock market, we're going to look back and say, yeah, it was just a leading indicator for stock market. I think that's probably what's going to happen. And I can show you a few charts. If you just give me 2 minutes, I'll run through my chart deck and just take a minute and show you why I think that. And part of the reason is, first of all, I'll start with my favorite ratio in the entire business is the ounces of gold for 1 Bitcoin. It's broken down through key support at 25. It's at 21 now. Our model says it should go to 13. I pointed this out for a while, but the bottom line, why I stick with it going lower, is stock market volatility. 120-day volatility is still absolutely buried at the lowest since 2021. If we end the year here, meaning if we don't have more volatility, it'll be the lowest year end since 2017. That's unlikely. To me, it's just getting started. And I want to show you the same thing, as we've never had a year with gold up this much and Bitcoin down this much. This is a Bitcoin down ratio without the S&P 500 down on the year. Now, we've only had 2 down years since Bitcoin was launched, and since 2008. And this is still a red year. What if it goes red on the year? It would make sense. It's hopefully, and if it doesn't go this year red, we're probably going to get the 3rd down year in the S&P 500 since 2008. It's just a matter of time. That ratio is telling us. I also point out, here's one key thing that really concerns me, is this is the S&P 500 in ounces of gold. You can go back 100 years. It's breaking down through key support. It's broke through that low in 2020. This is a month end. We have to go back to the base was set up 10 years ago, 15 and 16. We're potentially going to break through that level. At the same time, I overlay this with Bitcoin versus gold. It's also breaking through key supports. And then I like to point out, here's the key leading, the tip of the iceberg strategy. We all know what strategy's 200-day moving average rolled over. Bitcoin's 200-day moving average has rolled over. It's hard to see it here, but it has. What's next? S&P 500. It's logical, but here's another key reason. This is the VIX 200-day moving average. It's been in a bull flag pattern since May. It's just breaking out higher. It's just getting started. So I also like to point out another key thing is, again, here we have stock market volatility buried. This is 120-day volatility, but this is another way to look at gold divided by S&P 500. 200-day moving average is just starting to turn upward. And again, what's the same thing? We have the VIX absolutely, or actual volatility, absolutely buried versus the VIX. It's just a matter of time. It catches up and VIX goes higher. It's just a question of when. So I have two more I want to show you. And this is one thing I'm concerned about gold, and definitely want to know your view on this, Andy, is here's just a gold chart going back to 1971 when we came off the gold standard. And I like to take it simplistically, just to take gold versus its 60-month moving average. It's exceeded the high from 2008 a little while ago, and that was only a 1/3 correction. And then exceeded the high from 2011, which was the peak that lasted for 10 years. You have to go back to the 70s. This is when it went from 300 to 800. I remember this. And then it went back to 300, and it stayed around that level for 20 years. It's not a place I want to be outright long gold. That's why I'm concerned about selling everything. And I'll end with one key chart that might be the next big trade. This is the total return of the TLT ETF divided by the total return of the S&P 500. See that hockey stick going straight down? I'm afraid it's going to do the hockey stick part now. It was hovering. This is just from a base of 100, 2001. It hovered around 100. The peak around 2020 was 100. Now it's at 22. It's so buried. All it takes is a little flip for that to pop up. The S&P 500 giving back some more gains this year, and I think we're going to see that hockey stick kick in. And yes, I've been wrong on this one for 2 years.
Andy, do you have any comment on his gold thought process there?
You know, I guess the only thing that really comes to mind to me when you talk about going back and looking what happened in 1980, you know, at its previous peak, Volcker raised interest rates to 18.75%. That's not going to happen now. I don't know how many global rate cuts we've seen this year, 500 or more globally. The pattern is for lower rates, of course. At least that's what they want, and I think it's very different when you see countries like Poland, who started out with their target at 20% for national reserves, raised it to 25%, and now they're going to 30% national reserves. You look at the amount of gold that is being imported by the central banks. There was just an article that came out that said only 1 in 3 transactions is actually being reported. They're buying way more than they are telling all of the central banks. You look at the United States, we've become a net importer for the first time ever, and we're importing billions and billions and billions every single month. I think it is different this time because a system, the United States, which has flourished, you go back to 82, interest rates fell at a 45-degree angle ever since, making traditional assets what everybody wanted, and this country was revered and trusted. And you look whether the repo market right now, where the banks aren't trusting each other because there's double the liquidity in there than we had it in 2019, and yet the Fed just came in with 125 billion over 5 days. That's crisis level. You look at the backwardation in the silver market. They don't trust that they'll be able to roll their contract forward and get it in the following months, or they don't want to cash settle. They want the metal now. You look at de-dollarization. You look at all of this stuff. It's all based upon a lack of trust, whether it be globally with the de-dollarization and the Treasury issue with sanctions and tariffs masquerading as sanctions. You look at all of this stuff, and I see an issue of trust and fiscal irresponsibility, where in 6 weeks that the government was closed, we added $500 billion in debt. The previous trillion happened in 71 days. A trillion seconds ago was 31,688 years ago. We're fiscally irresponsible. Nobody trusts us. The markets don't trust anyone. The banks don't trust anyone. This is a game that I think is about the United States has lost trust, and the markets have lost trust. And even the participants in the overnight repo market trading 24 hours next day, not even just overnight. No, I don't trust you. So why did the Fed have to come in and put 125 billion in? I think it's different in the respect that you could argue if it were a chart that the U.S. peaked on its way up to 2011 or 2020, and it started to come down. And that's kind of where we are now globally with the lack of trust. So to me, gold is trust. It's trust because it is not someone else's liability. It's an asset that has no counterparty liability if it's in your own possession. So I get it. I get why you would say that, because history hasn't been kind to gold. But I would argue maybe history won't be kind to the US dollar the way that it once was, or the desire to hold our treasuries the way that it once was. So I guess that would just be my own pushback. I'm not the guy to talk to when it comes to charts. I follow everything you're saying, and it makes great sense. But, maybe, and I'd like your point on this, Mike, and all three of you. You guys are technical analysts. I would argue that the metals markets have been, for a very long time, manipulated by the Western central banks, period. Is technical analysis valid in a market that has and has a greater amount of central bank intervention? At what point does that painting the tape or does the reading of the charts maybe not work out the way one would think?
I think that's a great question, partly because it's a lesson I learned in the trading pits from a lot of very successful traders who did not care about the fundamentals. And most of them are either dead or retired, not all very wealthy. It's the discipline of what charts can help you do. Now, what you said about gold are known knowns. I appreciate them. You accelerated it. I got it very well. I've been very bullish gold forever, but at a certain point, I have to switch off my hat to from fundamental or technical analyst. I'm both. I'm whatever I think works, to a risk manager. And I look at it, if I'm running any money now and everybody in my desk is overweight gold, partly because the market made them overweight gold, this is a level I have to be very cautious. Now, I'm very worried what it's going to do, something similar to in 2008. Initially, remember 2007, it was up 30%. Fundamentals are great. It popped up 1,000 in 2008 in Q1, and it dropped to 700, dropped 30% as we entered the crisis of 2008. I think that's happening now. And that's part of what gold just front runs things. But that's why I just put on my, I've shown that chart. I just put on my risk manager hat and says, basically, when you get this stretched in gold, and the fundamentals everybody gets, it's just we haven't had the pile on yet from stock market going down, is to have the discipline of knowing where and when to buy. Now, you've been long and bullish gold for quite a while. I have, and basically been way overweighted. And I look at, sometimes it's okay to say, take some profits and do a little selling when the market's yelling.
Let me just, on one point that I'm glad you brought up 2008. When that happened, when the price fell from 1,000 to 700 in gold and 21 to 9 in silver, what was very interesting in my market was that there wasn't an ounce of gold or silver to be found for the second half of the year anywhere. I thought we were going out of business, and I'm dead serious. In 2008, the U.S. Mint shut down a half a dozen times. The Perth Mint in Australia ran out of product for the first time ever, took no new business after August. The Rand Mint in South Africa was cleaned out. One wealthy Swiss businessman flew a 747 there and cleaned them out for the first time ever. The Canadian Mint, the Australian Mint, and the Canadian Mint, the Austrian Mint, and the UK Mint were working 24 hours a day, 3 shifts, 8 hours apiece, and they were as much as 12 or 14 weeks backordered across the board. And nobody, I mean nobody, sold anything. I am a authorized reseller of the U.S. Mint. They said, we will take no orders. We'll let you know when you can take it. And when they finally came back online, months and months later, into the fall, right around this time, they said, fine, we'll take your silver maple leaf order or your silver eagle order. With $9 silver, you're going to pay 18 or 19 bucks, and you're going to wait 8 to 12 weeks to get your product. You got to pay up front. And the same thing was true with gold. What I'm saying is it was a paper-derived smash-down drive-by shooting. And if you do that now with naked shorts when silver's in backwardation and the exchanges are being bled dry, that's exactly the environment that these traders across the globe are going to jump all over and say, fine, we'll stand for delivery. Where's the product? And that, to me, is an existential threat. And I wonder, is it true to you that the only way to manipulate a market is to push it in the direction that it is going? But when you throw in the delivery ability to stand for delivery, like we're seeing in silver, and the chaos that's creating in both physical silver and in SLV, I don't know. I think it's something that these traders would need to think very, very cautiously about, because I can tell you in the physical world, there was not one person that sold anything and the price just cratered. So I don't know. It's nuanced for sure, but again, could it be different this time? Don't know. It feels it to me in my gut, but I defer to you guys. You have the career in technical analyzing these markets, and I respect that. But I'll tell you, that was a weird time.
Yeah, I would say that For me, technical analysis is a great way to manage risk, as you mentioned, but is not a crystal ball. So I don't pretend that I know where the market's going. I just know where I want to buy and what criteria I would take to prove myself wrong. Right. I just think I need some justification for discrediting my idea that I can move on with. But, I think that there's much bigger wins that are driving markets than the lines on the chart, just to your point.
Yeah, and just a couple points on that too. And I think this goes to both Mike and Andy's point, is that short term is where technicals really flourish, right? So the short term, because technical analysis is showing us what human emotion is doing. When there's max greed, you get drawdowns. When there's max fear, you get bounces and bottoms. But projecting out longer term, that's where fundamental analysis to me is really more accurate. And so I think, believe it or not, you guys are both correct in at least the way I'm looking at it. A couple things I want to show you guys here. This is the 1979 bull run. I think I've shown you guys this before, but it's you had this first initial move up, then long basic consolidation, and you actually had 9 straight up weeks in gold in 79 before the top. Here you had the same move up in 2025, sideways consolidation, and what do you know? 9 straight weeks up before we topped out on gold. Now, what's interesting here is you can see here was our pullback. Where did it take us to? Look at this. It took us back to the previous high of the consolidation phase here. And this is kind of what I'm looking at, right? So as a technician, I do think we see a little bit more downside in gold in the near term. But ultimately, I agree with Andy that it's way different, right? So the pullback, we could come back down into this 3,600 level, which would be about a 20% drawdown. And while that sounds big, it's only taking gold back to 3,600, right? I mean, it's not that big considering the bull run we've seen. Then the key here is the difference maker, right? Andy, you mentioned it. You had Volcker raising interest rates. Debt to GDP in the US was 30% in 1980. It's now 130%. So I agree 100% that versus in 1980, this was the high for literally decades. I think, again, we springboard off of this and we go right back up and make new all-time highs in 2026. So, yeah, just my 2 cents on that. But I think it's important to recognize that technicals are very good short-term indicators, but longer-term fundamentals rule.
Yeah, no, it's really interesting to see that. And I respect it and I follow it and I give it consideration. For me, I look at things much longer term, and I respect the trading. That's just not my mentality, but I like to hear it, and I understand what you're saying, and it makes a lot of sense.
So one thing here, we only have a few minutes left, and I wish this show was longer for that reason, but I got to just bring this up, guys. And I did want to touch base on more crypto with Scott too, because I think it's just, I mean, it's a bloodbath out there. I know you don't want to talk about it. Maybe
I love talking about it. That was sarcasm. Let's go.
But no, I know. But this is concerning me. And I'll defer to Mike on this and you guys, but this is the Japanese 10-year chart. And all of a sudden, the 10-year yield is spiking. This is the daily move on the 10-year, right? And one thing we know is that debt to GDP in Japan is higher than the US. It's like 240%. Are we on the verge of a credit issue, a debt issue? I mean, again,
this is the most important chart in the world.
What's that? Yeah.
I think this is the most important chart in the world because the world is powered by 0% rates on the yen. Everybody, $20 trillion, I think, is the carry trade still, even after we had the theoretical unwind in the past.
Yep.
And that's literally people borrowing the yen at a very low rate to go buy other things at a higher rate. Scary to see that unwind as this makes new all-time highs. I mean, basically, the entire world is priced in Japan being Japan, and they have just completely lost the plot and let it go. So this is legitimately scary. I don't know if it's a crypto issue or a world issue. I would say a world issue. But yeah, Mike, I would love your take and Andy's. But I think it's really, really important.
Oh, Mike, we don't hear you.
Take myself off mute. It's a major memory lane for me because I started trading JGBs in 1995 at night in New York. My kids were young, and I remember that very well. Didn't have 30 years then. It was just 10-year now. And I think that's significant. It's a reflation, but remember what the situation is. It took more than 30 years to get here. The 10-year note yield in Japan is still around 1.8%. The 30-year obviously going up. They don't have the depth of the market we have. It's not even a fraction. I mean, who would buy Japanese bonds and they were negative forever? It's also an indication, but the bottom line I like to say is, yeah, that's something. Just remember, that took decades to get there. And what got it in the first place for that reflation? The stock market and the equity and the housing market and real estate went way too high, and then it simply mean reverted. So they had to turn on the spigot forever. That's exactly what's happening in China right now. China's in the middle of that, and that's the next trade for the U.S. in my view. And to me, so that's why that's important. But right now, I'd watch that 10-year note yield or even 30-year note yield in China, and it's 1.8%. I think that's where the U.S. one is going, because Japan, it took 3 decades to get there. China's just getting started, and I think maybe we'll get to where they are after we get through the next iteration of massively pumping the system with liquidity, which China's doing more than Japan ever has, and it's next for us. But we did pump the system with liquidity most ever, and now we're on getting towards that hangover. Cryptos are showing the hangover. Stock market's probably next, and I don't see what stops. I can show you one chart that solidifies my view on that, and that's the key thing I want to ask Randy. You might view this as technical. What this is the 200-day moving average of VIX. This right here in 2007, that was the lowest ever. That got me really, really bearish the stock market. I held on for a while, but it turned out to be one of my best trades ever. I just held on to shorts and took forever. So the VIX gives you great, I don't look at it as technical, as an indicator of what's happened. This is what it's done this year. It's hovering right at this bull flag is right at the same low that was from 2011, the highs from 2006, the low. It's above these levels. It's a bull flag. This is telling me something to get out of risk assets. And cryptos at the top of the risk assets. So I don't know if you consider this technical. I view this as an indicator that something is going to happen. And that's why I think part of why gold just figured it out early this year.
Yeah,
What are
I
your
mean,
thoughts, Andy?
yeah, well, I mean, look, I look at what's going on with the carry trade. You got Japanese pension funds pulling out 1.1 trillion out of U.S. Treasuries now, because keeping money in America loses them money after hedging costs. And when you have Japan stop buying, interest rates wouldn't just stay flat; they would arguably explode. And and I think that's the issue. When you have 1.2 trillion in borrowed yen funding crypto, stocks, emerging markets, all this stuff has to unwind. And every hedge fund, every momentum trade, every leverage bet built on free Japanese money is getting margin called. I think it is a very important trade. And I don't know, December 18th is a big day for Japan. There's a 50% chance they hike again. So what happens then? I guess you could say the world's biggest piggy bank just got smashed a little bit. I don't know. It seems that way to me. It seems big, very big, and I would agree that it's probably bigger than people think.
That's what I think too. And again, speaking of which, you're talking about how it's the piggy bank for a lot of crypto and leverage, and that brings us back to end on this, Scott. And you've seen Bitcoin collapsing. ETH is back. I think it broke 3,000 today. There are altcoins that are hitting 52-week multi-year lows at this point. Is this just de-risking? Is it leverage and leverage issue? Is there fundamentally any issue here, or is it, give us a sense?
No, we've just proven that time travel is possible because we've taken prices back a decade. I think that the liquidation event of October 10th is a bigger story than people realize, when we had $19 billion in liquidations in crypto, largely on Binance. And that was 1.1 million individual accounts that were blown up and completely liquidated, most of which had stop losses that didn't fire. So you're talking about 1.1 million soldiers in a very small market who no longer have money to participate in this market. So if ever there was going to be a bid for smaller cap altcoins, those people are flushed, right? So I think that is a huge story, and that there's yet to be bodies that float to the surface. I'm sure that there are hedge funds that blew up, smaller institutions, and I think we're yet to see. There's been no bid for 99% of the altcoin market for this entire, if we even want to call it a cycle. I wouldn't, but most of these coins effectively haven't had a real buyer since their first pump in 2021 or 2017. A few have obviously risen above that, the large caps that I think have found enough Lindy effect or have just existed long enough, Metcalfe's law, to be here. But most of them are speculative VC investments, and those are going to be the first things that people can dump in a 24/7, 365 market. And I think, Bitcoin's the only game in town if you want to play it safer relative to the crypto market. So I think most of these altcoins are dead, right? And I think, listen, I mean, FTX token, I haven't looked of late, but a few weeks ago was trading at a $400 million market cap still for a bankrupt exchange where the founder is sitting in jail, right? So these tokens never really go away. And that's just a lot of extra money sitting in the market. I think there's a lot of people that are permanently trapped in most of these tokens, and they'll just die. And eventually that will all sort of, I think, fold its way into Bitcoin.
Can I add one thing to that?
The larger caps.
Sure.
Yep.
One day changed the narrative in cryptos. That was October 10th. November 20th, I think, is the one day that flipped the switch for stock market. NVIDIA crushed it. Market went down.
I agree. I think
And you guys remember that Mike said sell everything on October 9th.
Well, nice
the
to get
day
a little
before that happened. It was we were here on a Thursday. He said it, and at the same time, I said I thought the Bitcoin top was in at 126, very begrudgingly. Then again,
we're gonna get a crown.
I said it would range down to 100, and here we are at 86. So I don't get any flowers, but I did think that was the top for then. But I was seeing the same sort of euphoria at 126 that I'm seeing the flip side of angst and fear now.
But your 50-week moving average has worked like a charm.
Yeah, it's brutal.
I'll leave you guys on this. So speaking of crypto, I did pick up. You guys know I'm a shorter term trader, right? So it's not a matter of long term loving or anything. But I will say I did dabble on MicroStrategies in the last few days, and the reason is look at this. Look at what we've back tested into all of this right here, and look at where we are today. And so just as a short term trade. Right. I'm long MicroStrategies for a bounce. I probably won't stick around for more than 10-15% upside, but for everyone out there, I am long MicroStrategies. Didn't think I'd say that for a while, but it's gotten pretty darn low.
But that's the key thing, Garrett. In a market like that, you can pop 10-15% in a day. That's what bear markets do, right?
That's right. Absolutely. 100%. All right, gentlemen, you guys are amazing. What a great panel today. Andy, thank you so much for joining us.
Thanks, Andy.
Scott Melker,
Thanks,
Mike
fellas.
McGlone, socials are below. Andy, where can people follow you? Just give us a heads up.
Miles Franklin Media on YouTube would be the best way to do it.
Wonderful. Wonderful. Thank you guys again. We'll see you next Thursday. Have a good one. Take care.